In today's Closing Bell Exchange, we have Josh Brown of Fusion Analytics, Lee Munson of Portfolio LLC, Oliver Persha of Gary Goldberg Financial Services, and our own Rick Santelli. And I should point out, none of these gentlemen is the Facebook bull that we're talking about. We will get to him a little bit later. Josh, is this a head fake rally? I mean, that's really the question we want to get to at this point. Very low volume, very low volatility, but the markets just continue to drift higher here. What's going on?
Yeah, we're actually calling those two, volume and volatility, the volcanoes that could erupt at any time and actually matter. But they haven't mattered for a very long time. I think there are some real positives here, and the most positive being Wall Street is so far behind the curve. They are so bearish. This is actually the first time since 1999 that stocks have been above their forecasts by this much this late in the year. So that's number one. The only real negatives, aside from volume and volatility, which I think are a little bit overdone, is the fact that we're not seeing as many new 52-week highs as we were earlier in the rally. And so that's the kind of divergence that you don't want to see. That's one thing that every investor can track, and is probably a very good tell. It's not perfect, but as good as you get.
But can you really read too much into it, given volume? I mean, are we talking about Labor Day and the approach of summer, the end of summer, or are we talking about the election, which is sort of keeping people...
Maria, that's the bear case, that when everyone gets off the beaches in Europe and gets back to work, specifically the politicians, combined with Wall Street traders coming back and saying, all right, I have some gains, I'll prune them, that's what people are worried about. I don't know that it'll matter as much as people think, but that's definitely out there, and it's a reason to look at things like these divergences, like less new 52-week highs versus 52-week lows. It's a reason to say, all right, there's a huge gain, but right now not as many stocks keep breaking out, so maybe I'll take some off.
Lee, I don't know, you're looking at the S&P at 1440 by the end of the year. Have you been raising your target as a result of this rally?
No, I haven't. I started the year off at 1440 and moved around. Now I'm just back where I started back in January. But I think, Josh makes a few good points. On his blog day, he talked about how all the earnings, Wall Street beat, and he'd never seen that before, and I'm in that camp as well. But, Maria, I don't think that people should look too much into volume. The truth about volume is kind of like the truth about employment. You have people who are just not there because of seasonality, but then you have, you talk about employment, you have the people who have given up looking for work. We have investors that have given up on looking to invest money in the market versus, say, 10 years ago. So when we see these stats for the New York Stock Exchange, the volume, there's two things we need to look at. First of all, Apple. It's a high-priced stock. Why don't we ever look at the amount of dollars being traded in terms of dollar volume versus share volume? Number two, how many individual investors out there are no longer looking for work, no longer looking to buy? I think that would mitigate some of the volume, argument to some extent.
The other side of the coin, Oliver, is you say this rally is actually a head fake, that there are dangerous signs for this market ahead.
Yeah, so right now on a technical basis, obviously we continue to inch upward, and we think that's likely to continue through the end of August and possibly September. But when you look at it from a historical perspective, stocks are up about 17% over the last 12 months, where earnings and revenues are up low single digits. That's not sustainable. We all know about the fiscal cliffs and some of the headwinds that we're facing going forward. So we think that 2013, in particular the first half of 2013, is going to be very, very challenging for investors. Now, that doesn't mean there aren't going to be winners in there, but you'd better be careful and do your fundamental analysis.
Rick, still some confusion about the role the ECB is going to play in trying to fix our debt crisis. Are they going to put a cap on yields over there? What are they going to do? And how do you read the market's response to all that today?
Oh, yeah, no, confusion to the 10th power, and I think it continues. Volume used to be an important variable to monitor, It was like amps to electricity, but considering all the issues that everybody's brought up, it really hasn't changed the trend direction, which I find fascinating. Light volume or not, stocks have been going up, and they're staying up. Interest rates, since Mario Draghi's comments started going up, they're staying up. And I think in terms of the fiscal cliff, what always gets you are things you don't see. We not only see this coming, we talk about it every hour.
Yeah, guys, one other thing I'd throw in here on volume you have to keep in mind most of the market at this point is doing indexing. Most of the market right now is allowing asset allocators to buy and sell ETFs, and those are pretty static positions. We really don't have an investor class that's actively buying and selling stocks. The day trading community has dwindled because of attrition. They've been up against these algorithms that have knocked a lot of them out. So it's really foolish to expect a return to the volumes of the late 90s or even the middle part of the past decade. Investors are in the market, but in a different way than they used to be.
I agree. There's a structural change in the market, but I also think this low volume is something to be paid attention to. It is the market speaking to us right now. And Lee, maybe I'm going to play into your hand here. You know, when you get this kind of complacency in the market, this is not the kind of market you want to short. Do you agree or not?
I would not be shorting this market right now. I mean, we have a VIX that is making lows from the last couple years ago. A low VIX does not always mean it's time to go in to buy. Look at ETNs and ETFs that track the VIX. There's no new dollars going in there. So I think that right now, if you want to play the short side, it's suicide. And for those technical analysts, I would humbly disagree that what we're looking for is that testing and backfilling at 1440. And then I think we go higher.
All right.
Wow. All right. Thanks so much, gentlemen.